I asked for questions and comments on what our Wednesday training videos should contain, and a few of you came through. I appreciate it. Today we'll talk about finding and identifying patterns, plus another Bitcoin setup, so stick around. Hi, this is Tim from TradingStrategyGuides.com. I appreciate a couple of you guys coming through with material for our training videos. Today's subject may take a couple of videos to cover, but should answer most of the questions I currently have on my list. I still need more input. Comment below this video with your trading questions, and I'll include them in my training list. Before we get to the training, I want to look at our open trades and a new trade setup on Bitcoin. The Bitcoin setup may serve to answer a few of the questions as well. Remember, you can speed this video up by clicking the gear icon in the lower right of the video and selecting a new speed. Let's take a look at our open trades. The Australian dollar, New Zealand dollar is the only open position we have right now. It pushed up higher, but we're still waiting for it to hit the target. Hopefully today is the day. We've been waiting on this Ripple setup for quite a while. I wanted to remind you of it because it's looking weaker and the V and V are both continuing to decline. V and V is my new lazy, I got tired of saying volume and volatility shortcut for the volume and volatility, just so you know. Okay, let's take a quick look at the Bitcoin setup and then we'll get into the pattern training. Unless you're brand new to the channel, you'll know that we took a hit on this Bitcoin trade last week. In looking at this chart, I'm satisfied that the trade we took followed the rules, but we obviously got caught in a head fake. That's okay. As an answer to Noel's question, thanks for all your questions, Noel, by the way, there's no way to be sure whether you're in a head fake until it's over. I used the analysis of the V and V, volume and volatility, in an attempt to stay out of head fakes. And as much as I would love for everyone to think that I'm magical or something, remember that no trade setup is 100% sure, and there's no way to know what the market is going to do in the next few minutes, let alone the next few days. So, you manage your risk in such a way that it doesn't matter if you have to take a loss, then you find the competitive edges in the market and you use them to your advantage. This yellow channel is last week's bull flag pattern. We drew the pattern to the best of our ability at the time. The pattern had declining volume and declining volatility, and we took the trade on this break above the range right here, and I closed it when the candle came back and closed inside the bull flag. It was a good entry. The entry exceeded the volume average, so the trade followed the rules and was good, even though it was a head fake and closed back inside the pattern. I took the loss on the close back inside the pattern and kept my loss smaller than a full stop. As you can see, it dropped and it would have hit our full stop, which was right in here somewhere. Now, on further analysis, you can see that the volume has continued to drop off and the volatility has continued to drop off since that point. So that's the reason why I feel like this is continuing to be a valid pattern. So I redrew the bull flag to contain the candles that broke out, and this was the result. This particular pattern, while it contains these candles up here that broke out of the other pattern, actually matches the lower portion of the flag here a lot better. So I like this pattern, and we'll look for a break of this pattern. I do want to take this opportunity to answer another question, and that is, you can't look too closely at the individual bars in the declining volume here. You can see that there are higher bars here and there are lower bars here. What you have to do is look at the trend in the bars, just like you would look at the trend in the candles. The higher volume bars are continually getting shorter. They started way up here. These bars are at this level. These bars are down at this level. These bars are now down at this level, and so on. So you can see, if you look at the overall picture here, that these are getting shorter. You'll also notice that the lows are getting lower. So you've got a classical definition of a downtrend, and that is lower highs and lower lows. That's what you need to look for. You will occasionally get volume spikes, particularly on stocks. Stocks will show volume spikes on earnings days and that sort of thing. Those are what we statistical people would call anomalies, outliers. Ignore the outliers and look at the overall trend. You'll also notice here that the volume is dropping off. Now, you may not see the volume dropping off immediately. You see the pattern starts way over here, and you almost immediately see the individual volumes dropping, but the volume average doesn't start to drop off till it gets here. Well, that's because the volume average lags by 20 periods. So it takes a trend change 20 periods before it starts to show up in the volume average. You'll see a similar situation with the volatility. This volatility is set to the average of the last 14 candles. So this would represent an average of the range of the last 14 candles. So it's going to take some time for it to catch up as well. So all of that suggests to me that this pattern is still active. I redrew it. This is the result. Now, just so we're all up to speed on this, a bull flag has to start with a flagpole. So there's your flagpole, the uptrend into the bull flag. And then the bull flag consists of a parallel channel pullback, like so, against the trend. And we would anticipate this to break to the upside. And in fact, I will only trade a bull flag on a break to the upside. As usual, the setup is simple. I like my setups to be simple. We will be buying a daily close above the bull flag. We want to see at least average volume on the breaking candle. So this line is the volume average. So whatever candle breaks to the upside, we want to see the volume bar at least reach this average. If you've got at least 75% of the average volume, you can open a half-size position to reduce risk. You can calculate that by taking the volume number, divide it by the volume average number, and you should get 0.75. And that would be 75% of the average volume. If you don't get that number, don't enter the trade. It's as simple as that. Stand aside and watch it happen. And if it does what it's supposed to do, it doesn't matter, because you have created a higher probability setup by looking for volume confirmation of the breakout. If you don't have that volume confirmation, then it is not a higher probability setup. Your stop loss will be 1.5 times the ATR, and your target will be 1 times the ATR. So when you get a breakout candle, look right here for the ATR, multiply that by 1.5, and your stop loss will be that far below your entry. Your target will be 1 ATR above the entry. Now, yes, I use the average true range, or ATR, to measure volatility as well as finding a stop loss and a first target. If after entering the trade we get a candle that closes back inside the bull flag, we will take the loss right then and not wait for it to hit the stop loss. Our intention is that a breakout from these patterns should be explosive and hit our target fairly quickly. If the momentum goes away, we want to shut the trade down without taking a full stop if possible. When the price hits our first target, we will close half the position for profit and set the stop loss to break even on the remainder. We will then follow stops as price moves in our direction until the market takes us out. And that is the new Bitcoin setup, guys. All right, let's talk a little bit more about pattern recognition. These are most of the patterns that I look for. In addition, I look for trading range. We're going to treat that as a separate case for right now. There are a lot of different candle patterns to be found, but I try to keep things simple. I consider these the highest probability patterns when combined with the volume and volatility parts of the pattern that I look for. You're going to hear about harmonic patterns, the Gartley, the butterfly, the bat pattern, and so on. I've tried them out, and I just find them to be overly complex. I'm not saying that they don't work. I'm just saying that they're not good for me personally. You might want to take a look at those. You can just Google harmonic pattern trading or Gartley patterns or whatever, and you can find out all you want to know about those. I'm just not used to looking for them, so I don't see them as readily. There are also other patterns like the measured move, the ABCD pattern, the 1, 2, 3 reversal, head and shoulders patterns, and so on that are less complex, but I don't usually look for them either. Once in a while I will look at a head and shoulders or a 1, 2, 3 reversal pattern if one of them just jumps out at me. But again, I say I like to keep it simple. I don't want to spend all day poring over charts and measuring patterns. If you're new to all of this, I recommend you pick 1 or 2 of these patterns to start looking for and draw a lot of lines on a lot of charts until you find a match. I'll show you the important elements of each pattern so you'll know what to look for. This week I'm going to cover the sister descending and ascending triangles. The first thing you want to look for in a descending triangle is a strong support level, a line at which there has been a lot of price rejection. Price rejection is demonstrated by long wick candles. This candle on the left is an example of a long wick candle. Lots of price rejection down here at this level. Now, I drew this over here so that you could imagine what this candle looked like while it was forming. At one point, this candle looked exactly like this, and that looks pretty bearish. So remember that it looked like this at some point, but it ended up closing up here. So the price was here, then it closes up here, so that is rejected price right there. The larger the wick, the more violent the price rejection. The longer the wicks, the better I like them. Now, on this strong support level, I'm going to say this a lot in these videos, and I want to explain it right now. A line is never just a line, it's always a zone. Okay, these wicks and candle bodies will not all line up perfectly. Every trader has his own plan on how to handle reversal situations, and that creates a situation where you do not get agreement with exactly where the line is, and that's how it ends up to be a zone. Let me explain that. Imagine this situation. You've got a support line right here. Now, this support line was identified because you looked to the left on the chart and you found a point that price had reached prior to this, either on its way up or on its way down, and had stalled at this point. Lots of wicks, lots of price rejection before it finally broke through, and so on and so forth. Okay, so let's imagine this is a support line and price is now approaching this support level. All right, so you're going to have a group of traders who are saying, I think price is going to bounce at this level and I don't want to miss it, so I'm going to put a limit buy order just above the line so I get the trade before it hits the line. So these people are hoping that it's just going to touch this line, come down here, touch the line, and go. And they're betting by putting this order, this buy limit order right here, they're betting that price will pick up their order and then bounce. There's going to be another group of traders, and that's going to be these guys right here, who think that price will bounce from this level also, but they also think that it's going to push through the level first and then reverse back to the upside. And that happens often. You'll see price approach a line and it will push through it and then it will go on up and bounce. So they're going to say, I'm going to put my buy limit order below the line here, a few pips, and that way I'm going to get a better price and I'm going to reduce my risk because I can take a smaller stop if this doesn't do what I expect it to do. So if it pushes down here, it picks up this order and then continues on down, they can take their stop down here somewhere and have a much smaller stop than this person. If they decide that this isn't working, they'll have to take a much larger stop. And then at some point below the line, there's going to be a group of traders that say, well, this line has failed, so I'm going to sell. And so they have their sell stop order here. And at this point, I'm going to make a quick explanation. A limit order means if you have a limit buy order like this right here, that means price is above it and you want to fill the order as long as you can get a better price than whatever your order level is. So if this is your limit order, you will not actually get in this trade unless you can get in at a price below that level. Okay? A sell stop is where price is above it and you want it to enter when it touches this level. So you may not get exactly that level with a sell stop, because what happens is when price touches this level, you get a market order entered. And so the market order is going to fill wherever the market order fills, just like any other market order. In the case of a limit order, though, it will not fill unless you have a better price than that. But of course, a buy limit order has to be below price so that when price touches it, it fills. And a sell stop would be below the current price, and it would enter a market order as soon as price hit that level. That should be an answer to one of the questions that I got this week. I'll go into more detail about orders at some future video, but I did want to clarify that for right here. Okay? Now, with this having been said, you have the traders who placed an order here for a reversal, the traders that placed an order here for the reversal, and then the traders that think that it's going to go on down and they've filled their order right there for the break. Every time price approaches this line from either direction, you have a completely different combination of traders. It's a totally different group of people with different ideas and different goals. Okay, so the early entry traders, these guys here, the late entry traders, these guys here, end up smudging this line so that the line is no longer here, because sometimes there will be enough of these orders and those orders will fill and price won't make it all the way to the line before it goes on up. Then there are going to be those traders who reverse it from down here, so price will push through the line before it bounces. And that's the reason why a line is never just a line, it's always a zone. Okay? If you look for perfection every time, you will not find many of these patterns. When I draw lines for these patterns on the daily chart, I typically try to contain all the candle bodies, but I don't worry about covering all the wicks. Now, I want you to understand that I'm speaking totally from personal experience here. I spent many months actually expecting lines to touch exactly and reverse. And if they didn't touch exactly, then I didn't enter the trade, and I took, 1 or 2 pip stop on the other side of the line. If price pushed 2 pips through the line, I was out of the trade. So that's just craziness, okay? But I learned that from personal experience, okay? I experimented for many years before I actually got a handle on this thing, okay? So learn from my mistakes. A line is never just a line, it's always a zone. And that's also the reason why I look for candle closes outside of these patterns, and I won't take a simple break of the pattern, because a simple break of the pattern is not a real event, particularly on a daily chart. People take the daily charts very seriously, and a close below a level or a close above a level on a daily chart is significantly more important than just a simple break of the line, especially where stocks and futures are concerned, where the days are laid out in stone, so to speak. Forex, every broker might have a different day end, but in stocks and futures, the day has a positive end. Okay, after we find this strong level of support, the next thing we need to look for is a series of lower highs in the form of a downtrend. As price continues to pound on the support level, think of it as a trip hammer. Every time the price drops down here, it chips away at the buy orders that are happening here at this support level and continually puts pressure on that level until it breaks. The bulls are trying to push price higher, and they're having less and less success, and are unable to get this to turn back to the upside. As fewer and fewer traders are interested in the consolidation pattern, eventually those who are wanting it to drop succeed in breaking the support level, and then all the stop orders down here will get triggered. The stop orders I showed you earlier will get triggered, and price will be driven down with momentum. And that should continue for several days before the bears start looking to profit on their shorts. Our intent is to profit from that momentum as price continues to go down, often hitting our target on the very next trading day. Let me show you some examples from the charts. I wanted to show you some live descending triangles, but there just weren't any on my radar, so here's one that we took a couple of weeks ago. This is Canopy Growth Corp. You can see the descending triangle right here. You see this strong support level. It was attacked here, it was attacked here, 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 and even on this last day before it broke right there. I'll clear those lines off so you can see better. This had 5 attacks on it before it finally broke through, so that was a very strong level. Here's Cavco Industries. This ascending triangle, which is just a flip of the descending triangle, with strong resistance level here and a series of higher lows putting pressure on that. You can see this resistance level was attacked here, 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 maybe there, 3 times here, so arguably 7 times. Remember I said that a line is never just a line, it's always a zone. Here's a situation where price didn't quite reach that level, but here's a situation where it pushed way through it and didn't quite reach it here, but pushed through it over here. So as you can see, the momentum where we entered on the first close after the break, and the momentum took it up on the second day to hit the target. It actually hit the target here, but of course we didn't know it was a target at that time because this candle hadn't closed yet. It hit our target and then came back and hit our break-even stop. So we made a little profit on that one. Okay, this is Disney. It doesn't have a descending triangle on it yet, but I see the potential for it right here, and I want to show you what I see. Here's the situation. I'm going to draw this line right here, but I see a situation here where this line could be somewhere like right in here, and this could turn into a descending triangle. Kind of a sharp downtrend. I expect that it will not continue at this level, and it's likely to bounce down here. So I expect that we will get a little bit better looking triangle as time goes on. But I'm going to be watching for this to happen because, as I mentioned, I would anticipate price to bounce from this level here and come up here and make some other consolidation before it actually does that. So keep an eye on Disney if you want to see how a descending triangle forms. And lastly, let's take a look at Bitcoin again, because we have a situation here where there's more than one pattern on this particular instrument. Right here has the potential to be a descending triangle, like so. This is a pattern that's not likely to break soon, but if it does break the bull flag that I'm expecting, then that will negate this pattern here. But if it comes down here and bounces at this level, we could be looking at a descending triangle break here on Bitcoin instead of a bull flag. So that way we're kind of handled in both directions. But again, this is a situation where it's, strictly speaking, it's already a descending triangle, but I'm looking to try to play the bull flag first. And then if the bull flag fails, then we'll watch for this pattern right here. Okay, and that should cover the ascending and descending triangles. If you guys have any questions about those, please don't hesitate to put your question in the comments below. I try to read those comments before I do the next video, so I should be able to answer your questions, either type them right away or in the next video. So if you also would be so kind as to put additional questions and comments, trading questions, suggestions for training videos for going forward. I'll be doing probably for the next week or two, I'll be on these patterns and identifying these patterns and so on. But I'll need something to put on my list for after that. Well, let's go ahead and take a look at today's trading maxim. A maxim is a general truth, fundamental principle, rule of conduct, or a proverbial saying. These maxims come from various sources, books, internet, coaches, teachers, others. The purpose of my maxims is to motivate me to discipline. I suggest you start your own list of maxims to help in your trading, things that you can say to yourself while you're trading to make sure you always do the right thing. Feel free to borrow from my list. And once again today, we got another brand new one. Isn't that cool? Tim's trading maxim number 55. The magic you're looking for is in the work you're avoiding. That hit home. Somebody posted that on my Facebook this morning. Not specifically to me, just in general, one of my gym mates. What things in life are you avoiding? What things make you uncomfortable? What things do you just not want to do? Is there someone you need to confront about something? Is there a task staring you in the face that you hate doing? Maybe you should be exercising more or eating the right foods or changing the oil in your car or something. As some of you may know, I've been on a fitness journey for over a year now. I know, I never talk about it, right? First rule of CrossFit is to always talk about CrossFit. Anyway, I used to be an athlete. Then I just let it all fall apart, and it's caused me some serious health problems. So a year ago last May, I committed to getting healthy again. I've made considerable progress, but I still have a long way to go. Yes, I wish I could wave a magic wand and be done with it. And guess what? The magic is in the work. So you can wave a magic wand. It's just not like a magic wand, you know? The magic is in choosing to eat broccoli instead of donuts and doing burpees instead of not doing burpees because I hate burpees. The magic is in running even though I hate running. I put in the work and the magic is happening, okay? So I started at nearly 400 pounds in weight and I'm around 300 pounds now with about 70 or 80 pounds to go. I'm a pretty big guy. So I'm not special. I just made the commitment to do the work that I've been avoiding doing for years. So no judgment here. I avoided it for 20 years. If you want to be a phenomenally successful trader, there's no magic for that either. Only work. If you want to be good at it, put in the work it takes to recognize the patterns, to develop a trading plan that works for you, and commit to sticking to the rules. Commit to learning about yourself and your strengths and your weaknesses. Admitting that to yourself is the most important work. Put in the work and the magic will happen. Remember our Bitcoin trade plan? We're looking for a daily close above the bull flag to buy. If the volume is not quite average, go half size as long as it's at least 75% of the average. Your stop loss is 1.5 times the ATR and your first target is 1 times the ATR. And remember, I always put the link to the trade management video below. So check that out if you want more details. Be sure to come back to Trading Strategy Guide's YouTube channel every week on Monday and Friday for my analysis videos, and on Wednesday morning for trading videos like this one. I will most likely include a trade setup as well. Now I'm going to repeat the question I asked in Monday's video. I want you guys to help me figure out the most beneficial subjects to do for the training videos. Please comment below with your requests, questions, and opinions on what you want the training videos to cover, and I'll make a list. Please give us your feedback so we can make this channel helpful to all our subscribers. Also, follow me on Twitter. If things happen between my videos, I post it there. I'll put my Twitter link below. Tell your friends about us and help us make this the best trading channel on the internet. As always, thanks for watching, thanks for subscribing, and don't forget to hit the thumbs up below. Have a great remainder of your week, and I'll see you next time.